Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to this week's Top Stock Picks of the Week. I'm Tracy Brynick, and I'm joined by Shiraz Mian with two almost number one stocks. My pick suddenly has moved to a Zacks number 2 buy, but that's okay because it was a number one for many weeks. But Shiraz's pick still remaining strong as one of the top stock picks, but both large cap companies and names you know. So why are we talking about them if you already know about them? Because mostly people are ignoring these two top picks, both of which the charts look amazing and maybe you should have them on your radar. So let's dive right in with my pick, which is Facebook, ticker FB. So let's take a look at Facebook's fundamentals because this is why it is the buy stock right now. And as you can see, look at what's happening with sales. This year expected to be up 34%. And next year up 20%, and that's coming off already what was a big year in 2020. So they're really picking up steam now on the sales growth side. But the same is true on earnings. Look at this earnings estimates growth. And this is why, again, they have the higher rank, is because they got the big growth there. Plus they have down here all the analysts in agreement. So 15 have revised higher for 2021 after their last earnings report. That's why it's within the last 60 days. And then 14 are saying, hey, 2022 is going to look good too. So what does that actually look like in the numbers? You can see big jump here from 11.23. That was before their first quarter earnings up to 13. And then now from 13 up to 15 for 2022. So this stock is not one of the more expensive of the FANG or the big technology names because this E side is continuing to rise. So it's trading at 25 times. So that, again, is not a value stock, but it is among the lower of the FANG stocks on the PE basis. I think Alphabet is trading at 26 times, so it's right there with them. But Facebook still remains the cheapest because people basically don't like it. And it doesn't have kind of that cult following as some of the others, but it has the great fundamentals. And let's take a look at what those earnings fundamentals really look like on the chart. So this is the price and consensus chart here on Zacks.com. And you can see that this is what you want as an investor. You want year over year to be growing and going upwards to the right of the chart. And that's what we have. You can see the big growth for this year and next year moving in tandem with the shares, which are now at new all-time highs. And I wanted to take a look to see basically how that has played out since the IPO. Now, remember, they went IPO in 2012, so we're not quite there at the 10-year mark yet. But if you had held that whole entire time, you now have stock that is at the highs. Now, I compared this one with the triple Qs, which is the NASDAQ, because those are its peers. And it's been a little shaky a couple times in there throughout the years, especially here in 2018, where we had this big decline, and that was on the privacy concerns. Remember, where everybody was saying, you know, oh, I'm canceling my Facebook or my Instagram because they're not protecting my privacy. Well, the shares did bounce off of that here into 2020. They did sell off on the coronavirus sell-off, but that was another buying opportunity because fundamentals are good with most areas of its business. That advertising revenue has remained strong, again, even with boycotts and things that have been going on. And now these shares, after consolidating here a bit at the end of 2020, are now, again, breaking out into 2021. As you can see from here, Facebook up 775% since its IPO versus the QQQs at 566. Both are tremendous. And just in full disclosure, I do own Facebook in my own personal portfolio. I didn't buy it on the IPO because I didn't like the business model at first, but I bought a couple of years after that, but haven't bought in quite some time. But with fundamentals like these, maybe it's time to be adding to my position here. But Facebook, one of the strongest of the fangs here with the breakout and nearly $1 trillion market cap. So it's about to join that exclusive $1 trillion market cap club. But everything going well. This is one to watch on the second quarter earnings report as well. Now I'm going to turn it over to Shiraz because he's going to go with his large cap, which is one of the big cap banks. Yes, a bank. I know you may say that's boring, but he's going to show you why it's not.
Thanks, Tracy. My pick today is Citi. But even before I discuss with you why I like Citi, I would like to convince you that it's essential for all long-term investors to have exposure to finance in general and banks in particular. And this is one group of stocks that has a very good run this year. And perhaps if you don't own it already, did not enjoy the run, then you are of the mindset that you likely have missed the bus. And my goal is to tell you that that is not the case. Yes, you have missed the initial gains that the group enjoyed. But I see banks, finance, the broader cyclical space in the stock market to have a very strong positive momentum over the remainder of the year and next year. This obviously is premised on a cyclical outlook that envisions a very strong economic growth this year, and the momentum continuing over the next 2 years, albeit at a slower rate, which has implications obviously for inflation, which everyone in the market has been so focused on lately, and finance, and in particular the large money center banks or even the pure brokers provide you that natural hedge in the portfolio that on top of the cyclical leverage is the reason why I like the group so much. So getting back to Citi, the stock is currently trading close to its 52-week high, 79 and change, has had a very good run this year, up about 28%, roughly double what the S&P 500 has done, a bit modestly below what the peer group has done. And for the peer group, I'm looking at the large money center banks, JP Morgan, Bank of America, Wells Fargo, and the big brokers, Goldman and Morgan Stanley. So a little below them, but much better than the broader market. And I feel that and strongly believe that Citi shares, despite the strong gains this year, still represent the best value in the finance space. So the stock on a forward 12-month earnings basis is currently trading at 9 times the 9 times the forward 12-month consensus EPS. Now that is 70% of Wells Fargo, which we all know is dealing with a number of company-specific issues, 68% of JP Morgan, and 65% of Bank of America on a trailing tangible book basis, which is the preferred metric, valuation metric that bank investors like to look at. Citi shares are currently trading at 1.06 times, so a shade above 1 times. Now that is also at a significant discount to the peers that I mentioned earlier in the context of the PE. So relative to Wells, Citi is trading at 72%. on a tangible book basis, trailing tangible book. 51% of Bank of America, 41% of JP Morgan. So it's a cheap stock. It has a global footprint. There have been some issues with the lack of scale in many global markets that Citi has exposure to. The new management team is on the ball with those issues and handling them. And I strongly feel that over the long run, which is beyond the next 12 to 18 months, Citi will provide you a better vehicle to have leverage and exposure to the cyclical economic upturn in the U.S. as well as globally as we look past the pandemic. So just to repeat and summarize, if you have exposure already, you are in good shape. If not, I would urge that you seriously consider Citi as a long-term core holding for your portfolio. I'm not recommending Citi as a tactical trading opportunity, but rather as a long-term core holding.